There are two ways to think about what has occurred in the global economy. One is that absent all of the policy innovations put into place since the Second World War, another Great Depression would have come and gone by now. The other is that a long succession of political leaders, encouraged to a large extent by the professional economists, have with great consistency mortgaged the future for purposes of immediate gratification. And now the consequences of these actions have proven to be so severe that the house of cards repeatedly collapses. So the question arises, what can be done, if anything, to prevent the worst from happening yet again? Is a real recovery actually possible? If so, how can this be accomplished? What we hear from most economists and nearly all policymakers is that taxes are too high and are driving away job-creating investment. Thus, how government raises its revenue is extremely important. And as it turns out, the assets, activities, and types of income looked to for public revenue have very different effects on economic efficiency. A first priority for restructuring how government raises its revenue is to distinguish between earned and unearned income flows. The production of goods and the delivery of services should not be penalized by taxation. On the other hand, income that is gained by recipients of government-granted licenses, income that comes from limiting the competitive forces of the marketplace, are unearned and should be taxed accordingly. Monopoly license yields monopoly rents from natural resources. The United States until the early 1980s had a relatively progressive federal income tax structure. Some argue that it continues to be confiscatory, others that the system discourages economic growth. The problem, as I see it, is that the current system penalizes people who actually produce goods or provide services, while rewarding those whose income is passively or privilege, that is, rent, derived. A simplified but progressive tax structure would shift the burden of taxation more heavily onto unearned income flows, a high percentage of which is rent derived. This change would make the idle rich pay their appropriate share. How can this be accomplished? All individual incomes up to the national median and state median in those states that tax income should be exempted from taxation. To also achieve tax simplification, no other exemptions or deductions would be permitted. This graph indicates that the effective federal tax rate has been under 30% for those in the top 20% of taxpayers for decades. At the same time, the disposable income for this segment of society has continually increased. At the same time, the cost of living for those in the bottom 80% continues to absorb an increasing portion of household income. Beginning during the Reagan presidency, income concentration began to accelerate. As dramatic as this graph is, the numbers in dollars terms are almost incomprehensible. There are nearly 1.4 million households in the top 1% by income. Average incomes for 99.9% of this group reached $1.3 million in 2012, an increase of $424,000 just since 2003. To be included in the group who received the top 100th of 1% of income, you needed an income of $161 million. This group consists of just 1,361 households, yet receives an aggregate annual income of $219.1 billion. More to the point, Only 20% of us have incomes of $85,000 or above. In terms of assets held, the top 1% of all households owned 43% of all financial wealth. At the same time, the bottom 90% owe over 3/4 of all private debt. Payment of taxes has virtually no effect on the living standards of the top 1% of households, and certainly none at all on the top 1/10 of 1% of households. As stated above, the first change in tax policy that should be adopted is to exempt all individual incomes up to the national median. The national median is well above the poverty level, but is still a very modest income. The U.S. Bureau of the Census reported that the annual real median personal income is $31,100 in 2016. Thus, above $31,100, higher ranges of income will be taxed at increasing rates, sufficient to balance the federal budget. We could put up signs reading, "Welcome to our country. Most workers pay little or no income tax." Included in the annual budget would be the amount required to service and pay down the national debt. This could be accomplished in a generation by refunding all maturing government bonds with fully amortizing bonds that return both interest and principal to investors. Modest rates of taxation would then apply to the overwhelming majority of taxpayers in the United States, those who earn the great majority of their incomes by economically productive activities, producing goods or providing services. Above this level, almost all income is derived from passive investment activity and from speculation in the stock, bond, and commodities markets, in precious metals, in property, and in land. There would be no special rates applied to income derived from the sale of assets, so-called capital gains, for one simple reason: actual capital goods rarely sell for more than their cost of acquisition. Capital goods depreciate over time. What is today called a capital gain is almost always a gain derived from rent-seeking speculation in financial, property, and other markets. Inasmuch as most new jobs are created by small businesses with stronger ties to the communities in which they operate, we ought to encourage small businesses by exempting them from taxation. We should also push for legislation that favors cooperative enterprises over corporate entities. One way to achieve this objective is to abandon the business profits tax in favor of a low, graduated rate of taxation on gross income, exempting some amount of revenue, perhaps the national median gross revenue, before applying any tax rate. Importantly, much more revenue would come from those at the very top, again, from income derived from passive and/or speculation-derived sources. One now needs a minimum net worth of $2 billion to make the Forbes list. These 400 individuals have a combined net worth of $2.7 trillion, with an average net worth of $6.7 billion. Even if some of this income is earned by producing goods and providing services, a progressive tax on this income will hardly impact the lifestyles of the very wealthy. With a net worth of around $89 billion, Bill Gates remains the richest man in America. If the annual income of Bill Gates is just 5% of his total wealth, this comes to $4.45 billion. Even an 80% effective tax rate on this income would leave him with a disposable income of $356 million. The above proposal for a simplified but progressive form of income taxation should be thought of as transitional toward a system of public revenue derived from the rental value of locations in our cities and towns, our natural resource-laden lands, from leasing of frequencies on the broadcast spectrum, from rents derived from forms of licenses issued by government that limit competition, and other assets with an inelastic supply, such as takeoff and landing slots at airports. And yet, as the poster on the left reveals, there is a great need for public understanding of how the ways we tax land and property affects investment decisions that create jobs and generate economic growth. In recent years, these issues have been analyzed by the United Nations committees and associated NGOs. Another serious problem is the almost universal reference to housing instead of the more accurate term residential property markets. The markets for housing units and other property improvements operate very differently from the markets for land. As Samuel Clemens said long ago, buy land, they don't make it anymore. So, the supply of land is fixed by nature. As the demand for land increases with population growth, the supply remains the same. Moreover, in any region of any country, a significant portion of the land may not be suitable for development for reasons of topography, weather, danger of earthquakes or floods, and other reasons. We can construct an almost endless number of housing units, but only if we can acquire the land on which to construct them at a price people can afford to pay and still have enough left to pay for the cost of the housing itself. The market price of land depends on several important factors. For land valued as a location for commerce, office space, or residential occupancy, the most important factors are population density and proximity to public and private amenities. This is why land parcels in the downtown financial districts and in surrounding neighborhoods generally have the highest land values. However, high land value translates into high land prices because of the way most communities assess and tax real estate. For as long as public revenue has been raised by the taxation of real estate, there has been intense debate over the fairest and most economically efficient form such taxation should take. With only a few exceptions in the United States and elsewhere around the globe, the same rate of taxation is imposed on whatever assessed value is established on land parcels and the buildings constructed on those parcels. Beginning in the late 1800s, a number of public policy analysts and economists began to champion the idea of exempting all property improvements from the tax base, raising all revenue from the taxation of land values. Many gained their perspective by reading the works of the newspaper editor, reformer, and self-educated political economist Henry George. Over the decades, the theoretical basis as well as the means of implementation have been thoroughly studied and endorsed. The logic is straightforward. Every parcel of land has some potential annual rental value based on locational advantages. Well-located sites attract a strong demand, competition for control of these sites resulting in a high rental value. This value has nothing to do with what the individual landowner does or does not do on the land held, and everything to do with the public goods and services brought to the site. Thus, the annual rental value created by community investments rightfully belongs to the community and should be collected via taxation. Land parcels have a selling price because the annual rental value is almost everywhere taxed lightly or not at all, creating a net imputed and sometimes actual rental income stream that is capitalized by market forces into a selling price. Many landowners lease their land to others, such as companies that erect wind turbines, generating income without providing any actual services in return. The low effective rate of taxation on the rental value of land is what makes land ownership such a profitable and low-risk form of investment. The deeper impact on communities is speculation-driven land markets that make it more difficult for businesses to profitably produce goods or provide services, and for residents to become homeowners or find an affordable apartment. When speculation-driven land markets collapse, as they do about every 18 to 20 years, properties become vacant and may remain vacant for years. When the rental value of land is capitalized into a selling price, as is the case everywhere, selling prices provide taxing authorities with a basis for establishing an assessment value, which is then taxed at the same rate as whatever building occupies the site. In most instances, the assessed value applied to land parcels is infrequently updated. Thus, over time, the effective rate of taxation becomes lower and lower as the market price of land escalates. With the introduction of a system that taxes only location rental values, the selling price of land will stabilize and then begin to fall as more landowners bring their land to market for development to offset the rising cost of holding land vacant or underutilized. However, the annual rental value of land parcels may fall only until the supply of land previously held off the market has been developed and total economic activity in the community is expanding. This is the beauty of a competitive market operating competitively. Assuming land assessments are brought up to date and kept current with changing market values, the immediate benefits of exempting property improvements from the tax base accrue to owners of property with a land to total property value ratio below 50%. This describes the owners of most residential properties, particularly owners of attached housing units or units in condominium buildings and those with little or no extra land around their buildings. Owners of low-rise buildings on very valuable downtown locations would generally pay a higher tax based on land value than they do today, as would owners of vacant lots and surface parking lots. Properties that include significant excess land are also likely to pay more. Conversely, buildings that reflect the highest, best use of their location would generally experience significant drops in property taxation. Professor Nicholas Tiedemann at Virginia Polytechnic Institute is a strong proponent of a full shift away from property improvements to a land-only property tax base. He writes, "A very important effect of taxing land is the opportunity it provides for removing non-neutral taxes such as those on improvements. This is highly stimulative of development. A related stimulative opportunity that is created by taxing land is the opportunity to provide services such as water, sewerage, and electricity at marginal cost." Mason Gaffney is one of the leading experts in land and resource economics in the United States. He adds, "The unique, remarkable quality of a property tax based on land X buildings is that you may raise the rate with no fear of driving away business, construction, people, jobs, or capital. You certainly will not drive away the land. However high the tax rate, not 1 square foot of it will be put on a track shoe and hop out of town. The only bad thing to say about this tax's incentives effects is that it stimulates revitalization and makes jobs. If some people think that is bad, maybe this attitude is the problem." The bottom line message of this presentation is simple. The key to sustainable economic growth and to improvement in the standard of living for all is in these essential changes to the way government raises its revenue. Public subsidies to owners of land, for too long burdening communities and society with high taxes on earned incomes, on capital goods, and on commerce, must be eliminated. Where the cost of land comes down, businesses are able to compete with foreign producers and still earn acceptable profit margins. These are the fundamental requirements to achieve full employment and close the gap between the haves and have-nots that today plagues our society.